So in today's discussion, we will be covering a couple of topics. First, we will be talking about a very brief background about sustainable finance, what it means to, what is the taxonomy that we are using for sustainable finance. And also we will be talking about the role of ESG in sustainable finance, what ESG parameters mean in sustainable finance. We will also be advocating the role of sustainable finance and the importance of sustainable finance. Why do we actually need sustainable finance at all? Is it really needed? And also we will be talking about this recent developments in the field of sustainable finance, the bond issues, the green bonds, blue bonds, and other financial instruments that have been issued. We will be also talking about the role of, sorry. We will also be talking about the role of different regulatory bodies, governments, and corporates alike in transforming the sustainable finance landscape in the modern world. In addition to that, we will be also looking at what impact COVID-19 has had on sustainable finance, because the notion is generating some traction that COVID-19 has been good for sustainable finance. We will also look at the pros and cons, and we will also look at the benefits and the disadvantages that we have faced because of coronavirus, or COVID-19 as we generally refer to it. Sorry. At the same time, we will be having a little bit of a peek into the future of sustainable finance as to what we should expect in future sustainable finance in the coming years or decades. And then we will be concluding with the concluding remarks. And if you have any questions, you may ask those questions as well. So let's first go to the background. What do we basically know about the sustainable finance? Well, economies and businesses alike across the globe, they have been consistently struggling to integrate the transformative development and financing strategies, particularly due to the scarcity of financial resources, as well as the environmental degradation that we have been facing. Amid this exponential rate in environmental degradation, new opportunities to catalyze the financial resources and the environmental protection measures for better risk management have emerged. And those activities in the field of pooling the resources, the financial and the environmental, is generally referred to as sustainable finance. Well, sustainable finance generally refers to the financial products and services that integrate ESG, an acronym for environment, social, and the governance criteria for a lasting and sustainable benefit to both investors as well as the community. Because businesses do not exist in vacuum. They don't perform in vacuum. They receive their inputs from the environment. They receive their inputs from the society itself, and their products also go into the society. So they should be very mindful of the society. A mindless business proposition is something that's totally not acceptable to climate activists, governments, as well as to investors. Such a business proposition is totally not acceptable in the current modern world. So as I was earlier referring to sustainable finance as a financial service or a product that integrates the ESG factors. However, even in the current times, even in the current day, there is a lack of clear taxonomy on sustainable finance. What it really means to be, what it really means for a particular mechanism or a product to be classified as a sustainable finance. So therefore, we need to kind of, there is a very thin line that basically distinguishes the conventional finance from sustainable finance, and we need to be very mindful of that. Some of the examples of the recently issued financial instruments which have been classified as sustainable finance are green bonds. Microfinance is also, to my surprise, microfinance is also referred to as sustainable finance, of course, because it serves to one of the social aims and objectives of ESG of finance. Blue bonds, we have climate change funds, and we have many other financial instruments that have been issued in the recent times. So now talking about the three things in ESG, But let's go back to a little bit of a background and what is the real issue in sustainable finance. Now, some people might be confused that sustainable finance is perhaps a tool that helps us to, or this is a combination of some tools that help us to mitigate the risks and build totally avoid the environmental events or lessen their severity. That's not the case. Sustainable finance does not directly reduce the frequency or the severity of the extreme environmental events, but it's simply a mechanism which provides us tools to simply help us in mitigating the risks that result because of the environmental events. Of course, adverse environmental events I'm referring to. So again, as I said, there is no clear and there is no exhaustive definition or taxonomy for the sustainable finance. But for the sake of today's discussion, I will be focusing most of my discussion or most of my attention to a particularly environmental oriented investments or environmental oriented finances. So yeah. So basically, sustainable finance refers to building the capacity that helps us to mitigate the risks of environmental events. Of course, we know that these environmental events most of the times are unpredictable, and they may cause unpredictable damage, which we do not know, which we cannot assess in advance, and which we cannot prepare in advance, or which also cannot be avoided. For instance, most of us already know the deluge of 2014 floods, which caused havoc across Kashmir, and there was a huge loss of property and life across Kashmir, and we were not able to control that anyhow. So sustainable finance in this regard simply is a mechanism, or these are a combination, a pool of tools that help us to mitigate the risks that are posed by these environmental events, and also to build up the capacity of our environment so that they can absorb the environmental events of a bigger magnitude. So this is how sustainable finance is currently shaped. And it also supports the investments that are particularly focused on the eco-sensitive areas. For example, the investments which aim to reduce the carbon footprint of the businesses, because businesses are the most polluters of the environment. They produce most of the carbon that goes into the atmosphere. So the investments that actually support the innovations in the technology and innovation in methods and mechanisms that reduce the carbon footprint of the businesses, such investments can also be classified as the sustainable finance. Of course, the environment has remained the hot topic since the beginning of sustainable finance. It has remained at the heart of the sustainable finance. However, environment has only taken the center stage of sustainable finance only in the recent times. So, and also, as Dr. Bashir earlier mentioned, that UNDP's United Nations Development Program, their Sustainable Development Goals, 17 of them, it would be a surprise to know that out of 17 Sustainable Development Goals, SDGs we may call them in short. So out of 17 SDGs, out of 17 Sustainable Development Goals, 9 refer to environment only. 9 of them refer to environment only. So look at the importance of the environment in sustainable planet. And because UNDP has realized the importance of environment in achieving the sustainable goals, they have accelerated their efforts in sustainable finance issues to support UNDP's sustainable goals. So they say that, of course, we want to achieve all 17 of sustainable development goals, but we will be using a channel to support those sustainable goals will be sustainable finance, will be ESG finance, which will be environmentally based finance. And it must be, most of you might already know that UNDP has been partnering with the governments and the regulators and other corporates and agencies to support sustainable finance across the globe to develop capacity, particularly the capacity of the environment to withstand the shocks and withstand the adverse environmental events. UNDP also argues, as I said earlier, that sustainable finance has a huge potential to support the SDGs, Sustainable Development Goals. And to quote some numbers, as of 2016, $18.2 trillion have been already invested in this asset class. By asset class, I mean in sustainable finance, financial instruments. Besides that, as Dr. Bashir earlier mentioned, that the bonds market is also evolving very fast, like the green bonds and blue bonds are evolving very fast. So the sustainable business in the form of, or sustainable finance in the form of different sustainable bonds is also gaining a substantial traction in the recent times. So to understand how sustainable finance works, we would first like to know the difference between the conventional finance and the sustainable finance. Well, when we talk about, so how does conventional finance or traditional finance actually work? For those who are not very well aware of how finance actually works, I would like to describe that the finance generally, or investment generally, works through a mechanism called financial markets. And financial markets are nothing but a conduit or a mechanism that helps channel the funds from investors to the potential entrepreneurs. And in return, those investors receive a profit, or in finance, we refer to that as return. So in return, they receive returns on their investments. And those returns are actually generated on the basis of a risk and return profile of the investment. So how risky is a particular business, and how much returns are generated for the amount of risk that is being taken in that particular business. However, the sustainable finance goes further beyond the potential, or further beyond the traditional risk and return metrics, as Dr. Bashir earlier mentioned, that our investments are based on a particular ESG metrics. And in conventional finance, we don't really pay attention to the ESG metrics, but we simply pay attention to the risk and return profile of an investment. While as in sustainable finance, sustainable finance goes further beyond those traditional risk and return metrics, and they evaluate the impact of any potential business investment on ESG of the environment, or ESG of the society. Now, what does those three things, ESG of the society, mean? E refers to the environment, and it generally refers to the issues like climate change, pollution, biodiversity, waste management, and energy efficiency. So it basically refers to how a particular corporate, how a particular business is dealing with, or what policies do they have in place to protect or to prevent climate change, to cause less pollution, to cause less harm to biodiversity, and what are their policies? Do they have the substantial methods or mechanisms in place to address their waste management, or in general, what are their waste management practices? And what about their energy efficiency? Are these companies still using the old and polluting energies, or have they been switching to new forms of energy which are less polluting to the environment? So this was E of the ESG finance, or E of sustainable finance. As earlier mentioned by Dr. Bashir also, that sustainable finance basically is a holistic approach which includes three particular dimensions: environment, social, and governance. So this is all about E, the environment. The second factor, or the second component of ESG finance or sustainable finance, is the social components. And the social components basically refer to equality among people of color and white and other ethnicities. Also, how about the protection and privacy of the employees, the engagement of the employees, discrimination, corruption practices, community relationships, how does a business interact with the community, and what are the different labor standards that have been adopted by the particular business. But again, for today's discussion, we are not much focusing on the social dimension of sustainable finance, but only on the environmental impact of sustainable finance. But anyway, I just wanted to give you an overview of what sustainable finance in general means and what it encompasses. The third particular field, or the third particular parameter of sustainable finance, is governance. And governance basically refers to how is the board structure, is it well balanced? What are the corruption practices in the organization? How about the audit? Whether timely audits are done, and whether the audits are done keeping in view the transparency or transparent reporting of the business performances, because it's often a tendency for the businesses to they always tend to over-report their performances to attract more investors, while as their actual performances might be just very low compared to what they're reporting. So audit is a mechanism which prevents such a misleading communication to the stakeholders about the performance of the business. And also, governance refers to the compensation, executive compensation, and also about the whistleblower policy, meaning if there are some unfair practices going on in the organization, how about a person who calls upon those policies and reports those policies? How about his protection, and how about how about the policy related to his protection? So that's what we refer to as whistleblower policy in general. This sustainable finance is a very broad theme, and to be honest, it might not be possible to cover all the aspects of sustainable finance at such a short duration. But anyway, I will try to do as much as possible to throw some light on all the aspects of sustainable finance. So now, why sustainable finance? A conventional investor or a traditional investor might ask that, why should I go for sustainable finance? Because if I'm investing my money, I'm basically looking for returns. So why should I really invest in business opportunities, or why should I invest in the investment opportunities wherein I might earn less profit, I might earn less returns? So what is the motivation for me to go for sustainable finance when I have other avenues available? So of course, as earlier said, that conventional finance or traditional finance is simply how the risk and return of an investment is being looked at or viewed by an investor. However, sustainable finance also evaluates, in addition to the risk and return profile of an investment, sustainable finance goes beyond and evaluates the impact of investments on the environment, on social and also on governance aspects. So someone might argue that, why should I go for that? Why should I go for sustainable finance when I have conventional tools available to me? So the evidence suggests that sustainable finance opportunities have the same or even better risk return profile, meaning they are providing better returns and have less risk compared to the conventional investments. However, sustainable finance is very good at warning us, or it acts as a warning signal against the businesses which have negative aspects towards the ESG and the society in particular. So it might help us it might act as an early warning signal to avoid the investments which have questionable practices. For example, the firms which have questionable practices, ESG profile, building an ESG profile for an investment might help us, or generally helps us, in understanding what can be the potential risks involved in a particular business because of their questionable business practices. For example, you might have already, most of you, since you are in environment, most of you would have already known about the BP's, the British Petroleum's Deepwater Horizon oil spill, which was of such a disastrous magnitude, and it was simply because of the ignorance, not because of the ignorance, but because of the unfair and questionable practices of BP. And also, you might have heard of Volkswagen's recent emission scandal. So this sustainable finance actually helps us in warning us early about those. So these are like early warning indicators of a business with questionable practices. So in that case, we would the investors would feel safe to avoid the investments which basically have some sort of risk because they are indulging in unfair or questionable business practices, which might in the long term or medium term lead to business losses, and eventually that will solidify as losses to the investors. So as earlier mentioned, that sustainable finance, it evaluates the negative aspects of business, actions on the ESG aspects of the society. But coming back to the main question, why sustainable finance? Sustainable finance also because sustainable finance enjoys a better credit rating. I don't know if Dr. Bashir earlier mentioned that there are some credit rating agencies which are basically rating the credit, rating the financial instruments. And quite recently, thanks to those credit rating agencies which have been incorporating the ESG evaluation of an investment, while they are actually rating different financial products. So talking about the sustainable finance enjoys a better credit rating, meaning, they have a less risk. So investors can be sure that the sustainable finance products have a lower risk and provide the same or better return. So this basically strongly argues a support for sustainable finance in comparison to the conventional finance. Moreover, what's the benefit of sustainable finance for the businesses? Because sustainable finance products, the product related to sustainable finance, enjoy a better credit rating, businesses can basically, they can borrow finances, or they can borrow money, or they can raise finance at a lower cost of capital, at a lower cost, because the interest rates that will be applicable to a better credit rated products, they will be always cheaper for the businesses. So the source of money is cheaper for the businesses. That's why sustainable finance is a kind of a win-win situation for both the environmental activists, also for the businesses, as well as for the investors. So, okay, so some numbers I have here. Of course, a lot of efforts have been already taken by the investor community. A lot of efforts have already been taken by these credit rating agencies that I was referring to earlier. Also, a lot of efforts have been taken by UNDP, and activists like you have taken a really good stride in arguing for a case for sustainable finance and sustainable environment. Actually, I'm sure that you will still excuse me for referring to sustainable finance when I'm referring to an interchange or interaction between the finance and the environment. So, yes, as I was saying that there has been a lot of support this sustainable finance has received from almost all the quarters of the society. But are those efforts substantial enough? It will be surprising to know that, of course, a lot of efforts have already been taken, but those efforts might not be sufficient enough. Reason, the Paris Accord, or the Paris pledge, the climate change pledges in the Paris Agreement, as Dr. Bashir was earlier mentioning, they cover only about 1/3. They cover only about 1/3 of the climate pledges that are promising a global temperature reductions or emission reductions that are required for a temperature below 2 degrees Celsius. So only 1/3, imagine 33%. So Paris Agreement is being so widely discussed in the recent debates in the environmental finance and environmental sustainability, sustainable finance. But again, only 1/3 of the pledges under the Paris Agreement are actually, covering or addressing the need for emission reductions that can reduce or that can keep our planet at 2 degrees Celsius lower, temperatures. Now, what has been achieved until now, and what has been the impact of COVID-19, or has, in other words, we might ask ourselves a question whether COVID-19 has been a good thing for environmental finance or a bad thing for environmental finance. Well, for environment in general, COVID-19 has been a good thing because, people traveled less, and the businesses actually realized, and even the executives realized, that they might not need to travel as much as they do, right? So because they can conduct the meetings and seminars like this one we are doing right now, a webinar. So businesses came to the realization that they might not need to travel as much as they do, and they can do a lot of things through the virtual mode, through online meetings and so on. And this also contributes substantially to the reduction in the emissions. Also, the lockdown measures that have been imposed across the globe, we witnessed that during the COVID-19, the environmental situation, the air pollution, the quality of the air that we breathe has substantially increased, substantially improved in the recent times. So someone might argue that COVID-19 has been very good for the environment. Of course, COVID-19 has been good for the environment, but not good for the environmental finance. What's the reason? I'll come back to that point, but before, let's talk about what sustainable finance has achieved until up to this point. International Financial Corporation, a World Bank member, reports that the green bonds market, when I refer to green bonds market, I'm referring to the environmental finance, not the ESG, not the wider sustainable finance. So I'm simply referring to the green or environmental finance only. So they report that the market for green finance has grown phenomenally in the recent years, aggregating to about $240 billion in bond issuances. And this has been in 2019. Now I will come to 2020 later. We will see what happened in 2020. So in 2019, the market aggregated to around $240 billion. And this, mind you, this is 3% of the total bond issuances globally. So the 3% of the global bonds have been issued in green form, meaning only green bonds have been issued for this amount. In 2019 also, because I'm drawing a line between 2019 and 2020 because 2020 was a COVID year, COVID-19 year. So that's why I'm drawing a line to show what the progress actually was and whether there was a structural break or whether there was a shift, a consequent shift after the COVID-19. In 2019, the green bonds were up by 50% from the previous year, meaning the green bond issues in 2019 were 55% higher than the bond issues in 2018. So this can tell you that the sustainable finance, particularly green finance, has been gaining a considerable traction until the end of 2019. But what happened in 2020? In the early months of 2020, when the sustainable finance in general and environmental finance in particular was gaining traction, unfortunately, this COVID-19 struck the globe, and it caused substantial structural changes in almost all the aspects of the business as well as life, and it didn't leave the green finance untouched. So what we witnessed, I'm again quoting some of the numbers here. Sustainalytics, an analytical or an organization which reports different numbers about the sustainable finance, they report that the green bond issuance in March 2020 has drastically reduced by around 70% compared to the last year. Now look at the pace. Between 2018 and 2019, the bonds market has grown by 55%. And between 19 and 20, the bonds market has shrunk by 70%, which is a huge number. Likewise, the Climate Bonds Initiative Group, again, an organization which reports about the performances of the climate bonds or green bonds, they report that there has been a recent drop in the bonds issuances, green bonds issuances between February and April 2020, only between 2 months, there has been a drop of 90%. So you can imagine how substantially has COVID impacted sustainable finance, and particularly how it has impacted the green finance. Well, if the things were not enough, ICMA, the International Capital Markets Association, and other credit rating agencies, they adopted the updated ESG guidelines for the credit rating. And when I say updated ESG guidelines for the credit rating, they paid more attention. In the updated guidelines, the shift was away from the environment towards social. So they didn't, earlier, environment received a substantial focus in the ESG guidelines for the credit rating agencies. But after COVID-19, these credit rating agencies, they adopted a new and updated ESG guidelines for credit rating. And those guidelines were basically a shift away from environment and more towards social. And subsequently, what we witnessed is a 600% increase in the social bond issuances year over year from the previous year. So from the previous year, 2019 to 2020, there has been a 600% increase in the social bond issuances. And remember, this increase in the social bond issuances comes at a cost of environmental finance. So we are basically compromising the environment for social issues, and all thanks to COVID-19, unfortunately. Okay. What else do we know, and what do we have, or what do we believe to be the future of sustainable finance? All right. Before we go that, I would like to just talk about a specific issue and what's needed for sustainable finance or environmental finance in particular to pick up again. There's a strong need to educate the investors as well as the businesses about the need of the sustainable finance with a particular focus on environment. And it encompasses many things. It encompasses from a broad theme of climate change to the supply chain management. In recent times, what has happened is we have witnessed a naked disregard for ESG by some of the major fast food companies, fast food joints, generally referred to as Yum. Let's call them Yum because they're so tasty. So there has been a naked disregard for ESG by those firms, because what they have been doing in the recent times is they have been using 20 different types of antibiotics to fatten their livestock, particularly chicken, because chicken is like the fast moving commodity in the fast food industry. So they have been using 20 different types of antibiotics to artificially fatten, or I don't know if we may call it artificially fatten their chick, artificially fatten their livestock, but anyway, fattening the chick, fattening the livestock. Well, because they were doing that, and it came to the, somehow this whole play or manipulation with the supply chain came into the notice of the investors and also the consumers. So when consumers know that the food they are eating is being manipulated through the use of antibiotics, of course, the sales will decline. So while this was happening, so of course, there were many things that happened subsequently. First of all, they lost their sales. Second, there were divestitures. By divestitures, I mean the investors withdrew money from those firms because, of course, for being very selfish, they would expect that because the sales are declining for those firms, the profits will also decline. And as a result, the share prices will drop down and we will be at the receiving end. So one, there was a decline in the sales. Second, there were divestitures. Investors withdrew their money from those firms. And third, there was a strong reputational loss for those firms. And while this was happening, on the sidelines, the organic food industry was gaining the momentum. They were gaining traction. So the organic food industry, which were very mindful of the environment, which were very mindful of the climate change, which were very mindful of the manipulation in the supply chain, they gained a substantial traction. And as a result of which, organic industry, which was just a niche before a couple of years, has now become the mainstream. You would observe that across the globe, people are now crazy, and they're like very much oriented towards the organic food industry rather than the conventional antibiotic-based food industry. So why I mentioned this point here is because what I want to say is that businesses who consider that environment or being mindful of the environment is not a good policy, this example clearly exemplifies that the businesses who are not mindful or who are not conscious of their environment might be at the receiving end, because eventually it all boils down to the consumers, it all boils down to the investors, and so on. So and this thing, because again, there has been a widely held notion among the investors. There has been a widely held notion among the investors that perhaps, either we can care for the planet, or we can care for our businesses, or we can care for our profits. So this particular myth that has emerged, or that has always remained there, with the conventional wisdom of the investors is, both of them cannot be simultaneously achieved, and there is always a trade-off between the planet and the profits. So this example adds up to the evidence that, this profit and profit versus planet dichotomy is just a myth. It's not a reality, okay? Because the businesses that do not care for the environment may end up making huge and substantial losses. In addition to that, many other agencies like Bloomberg, MCSI, Morningstar, HSBC, and Bank of America, all of them have reported that ESG investments, meaning sustainable finance, has performed much better, not only over the benchmark, not only over those investments with worse ESG profiles, but also they have performed way above the benchmark. Not only that, the fluctuations in those ESG businesses have been very less, which confirms that the risk, the inherent risk in those businesses is also very low. Okay, now going to the future of the sustainable finance. What do we have for us? What do we have waiting for us? I think I mentioned this point earlier also, that UNDP, they consider that sustainable finance must act as a key source of finance or key source of capital to the sustainable development goals. And they have estimated that a bold climate action or bold climate actions together could trigger $26 trillion in economic benefits by 2030. So $26 trillion is a huge amount, okay? So if the climate actions can be taken, if bold climate actions can be taken, the world will be better off by $26 trillion, okay? So this is a huge number, once again. Talking about the profit versus planet, I don't know how much time do I have left so that I can go accordingly. Can I know, Dr. Bashir, how much time do I still have?
Yeah, you can carry on, sir.
Okay, all right, thank you so much. So going back to the myth that has always remained there at the heart of the conventional finance or conventional wisdom in finance, is that profits and planet cannot go together. They're always working against each other. Meaning, if we care for the environment, if we invest in environmentally sustainable investments, we might end up losing some profits on account of that. So again, I'm not denying the fact that investors have been historically conditioned to this myopic aversion to sustainable and responsible investment. And this frame dependence on the traditional notion of planet versus profit has stalled the investments in the sustainable finance for a long time now. Not only that, it has also led to considerable frictions between the stakeholders and the shareholders, as well as it has caused some antagonizing effect on the investors as well, so that they have developed this tendency to avoid the finances that are basically related to sustainable development or sustainable environment. But thanks to, as I said, that there have been educating efforts before. Many organizations, climate change activists, regulators have taken many efforts in order to educate the investors as well as the business community to kind of leverage this benefit of using sustainable finance for better profits. Because of those efforts, in the recent times, this ESG criteria of finance has become increasingly popular, particularly among the young investors. Now, I would like to quote one more example from my industry experience while I was working in Jammu and Kashmir Bank. The conventional approach, here I'm trying to talk about the interaction between the environment and the finance. So the conventional approach, or the traditional approach that has been used by most financiers, including banks and credit rating agencies, has been to evaluate the impact of environment on business. So this has been the traditional approach, how environment affects the business. But in the recent, not how business affects the environment. This is not how the risk profile of a business was done by the financiers. And I, being a part of, I was also working on the rural finance, as I said. So I was always assessing, or I was always evaluating during my practice, I was evaluating the impact of environmental events on the business itself. How sensitive is a particular business to extreme environmental events? For example, heavy rainfall, hailstorm, heavy snow, winds and other things, floods, etc. So I was always evaluating the impact of how those environmental events are affecting the business. So this has always remained a conventional, conventional way to evaluate the interaction between the environment and the finance. But thanks to the updated guidelines, the new approach is to evaluate both the things, a bidirectional interaction. A bidirectional interaction assessing the impact of environment on business and the impact of business on environment. So this has been the new approach, or this has been the updated approach on used in the sustainable finance nowadays. You must be surprised to know that among all the components of the environment, water has been the most prominent one. It has featured across all 6 dimensions of ESG. If we classify ESG into 6 dimensions, 6 further dimensions, water has featured in all 6 dimensions and almost in all of them by more than 50%. Okay, so this can tell us about the importance of water, particularly water in the environmental dimensions. Of course, other things are also very very important, but just I was just pointing to, or I just wanted to highlight the importance of water in the dimensions of environment. Going back to the numbers, UNDP reports that energy alone, as I said, that there are still many avenues for businesses to go for efficient energy management, waste management, etc. But talking about the energy, according to UNDP, energy alone has is causing more than 40%. Sorry, more than 40% of the world population is still using inefficient energy methods, inefficient energy, okay, which are unhealthy cooking fuels and unhealthy energy sources. On top of that, UNDP also reports that cities that occupy just about 3% of the Earth's land account for a mammoth 60 to 80% of the energy consumption and at least 70% of the carbon emissions. So smart cities is another way or another future investment that we should look for. Of course, the businesses should look for, because at the moment these the conventional cities are causing a lot of pollution and lots of carbon emissions. So the carbon footprint of cities is huge and must not be ignored at any cost. It's therefore time for the businesses to step up their investments in this particular field and of course other fields, so that the carbon footprint in general and environment, environment in particular and carbon footprint in particular must be taken care of. Another dimension is the fiscal dimension of sustainable finance. Now, imagine the cost, imagine the value, not the cost, imagine the value of the clean, fresh water bodies around us. Let's talk about Jhelum, let's talk about the Dal Lake. So imagine the value of these 2 water bodies in Kashmir. The value of these 2 water bodies is huge. And what we have done as individuals, we are polluting these water bodies around us, which of course have huge value, and we have been polluting them at an exponential rate. And we have been so mindless in our activities, causing harm to our water bodies in particular and the environment in general. So not only that, from the fiscal perspective, since I was talking about the fiscal perspective of sustainable investments, governments must also be mindful that they need to develop their strategies and policies according to, in a way, so that those policies are conducive, those strategies are conducive to the environment. Why? Because if they do not do that, then the cost of cleaning those water bodies lies on the government itself. So it's kind of a double-edged sword. If they don't initially invest, or if they don't take initiatives to protect their water bodies and their environment, of course, then the cost falls on them again. They will have to incur the cost. And we've been witnessing, without making any political remarks or without being, critical of any administration or something. So what we have witnessed over the last many years, we've witnessed that the Dal Lake is being continuously cleaned up, but it's never been clean. Okay. So, and how much cost and how much money was spent on that? How much policy making, how much time and effort it took for us to actually clean the water bodies, Dal Lake in particular. And, as I said, that if the governments are not, if the governments are not conscious and if they're not mindful of the environment around them, they will have to bear this substantial fiduciary cost, which comes in the form of cleaning the environment after we have made it dirty, after we have caused a deterioration in it. Also, I think Dr. Bashir earlier mentioned a point that intergenerational wealth or intergenerational equity. So why should we really care about intergenerational equity? Why should we care about future generations? Of course, we must care about future generations because it's not only the future generations that will get affected by our wayward behavior and wayward actions related to environment, but it's also us. Our fiduciary reserves, our fiduciary resources are getting used for cleaning up the thing, cleaning up the rivers, cleaning up the environment, which we could have initially in the first place protected from deteriorating to such an extent. Quoting once again from UNDP, the value of the ecosystems around the globe to human livelihoods and well-being is $125 trillion per year. Each year, $125 trillion, is the value of those ecosystems in which we live. And marine economy, since I was talking about the water, marine economy alone comprises 5% of the global GDP. But what we have done as individuals, here we cannot blame the governments or here we cannot blame the businesses. What we have done as individuals, as a member of society, we have shown a wayward behavior. We have shown a careless and mindless behavior when the pollution, the marine pollution, we figure out is as high as 13,000 pieces of plastic litter for each kilometer, each square kilometer. So it's a huge number, 13,000 articles of plastic litter for each square kilometer of our marine ocean. So governments, therefore, because as I said that the cost falls back on the government, so governments, therefore, must take the action, or if they don't take an action, they must be prepared to brace up for the disastrous consequences that may result because of the environmental events, that we are directly engaging in. And also, the temporary fixes will not work. So the temporary fixes, I'm not talking, when I say government action, I'm not talking about the temporary fixes, because temporary fixes are not only sustainable, but also unsuitable for managing the risks posed by the environmental events. We can never predict them, So it's always better that we do not manipulate, we do not play with the eco-fragile environments, particularly in Kashmir, because Kashmir has a large area of eco-fragile environments. We cannot manipulate them. We cannot, even a smallest pollution in those eco-fragile regions are prone to cause a disastrous climate event. So we must, religious tourism and adventure tourism are just ways, they don't generate enough revenues. They cause pleasure to some people, but at the same time, the cost has to be borne by the community in general. So such things, the governments as well as communities have to be very mindful of what results or what will be the consequences of their adventures to eco-fragile regions, and also, also the religious tourism that we are strongly arguing for, of course, without hurting the religious sentiments of any particular group. We must try to keep the religious tourism to as minimum as possible to prevent those eco-fragile regions from turning into disastrous environmental events for us. In addition to that, where does the solution lie? What solution do we have now? Okay, if this is all we have got, what is the solution now? Where are we heading to? It's very prudent for the governments to incentivize investments in carbon efficient technologies, emission-oriented technologies, and also for central banks and regulators to put the guidelines and penalize the businesses as well as individuals from engaging in activities which will cause huge harm to our environment in particular. And I think, governments and corporations alike, if they do not resist from their mad race and crazy race for profits and mindless practices and mindless business strategies, then of course they will have to bear a huge cost, which for the government will come in the form of budget overhang, and for corporates it will come in the form of a debt overhang. So this is something that we must at all the costs prevent ourselves before it's too late. Bottom line, what has been happening in the COVID-19? Of course, we don't need to be discouraged by the fact that there is a shift away from E in the ESG metrics. Sorry, it should be metrics, not matrix. Sorry. So we don't have to be really worried about a shift away from E in the ESG metrics of the sustainable finance or sustainable investment, because early signs definitely indicate that there has been a considerable shift away from environment in the sustainable finance, as according to the numbers that we earlier reported. ESG issuances have grown significantly in the recent times. As you would have witnessed, that there was a 600% increase in the social finance or social investments in the recent times, just over a period of 1 year. But of course, what we will see in the coming times is for sure some sort of rebalancing between the three components of E, S, and G. In pre-COVID landscape, in pre-COVID financial landscape, we witnessed a particular and singular focus of environment in ESG, but that focus has to see some rebalancing away from E towards S, towards social dimensions. Of course, governance will always remain. It is not a significant proportion of our ESG. But anyhow, this interplay of rebalancing is expected to ultimately deliver a safe and sound planet for us, a healthy planet where we can live, and thereby also saving our intergenerational equity. And therefore, it must be realized by all of us, including governments, regulators, credit rating agencies, businesses alike, that the best time to scale up eco-friendly investments is now, and any time spent in delaying those investments or those initiatives is nothing but a cost to us as well as our future generations. Thank you so much.